Hello, I'm Richard Weinberger, the CEO of the Association of Accredited Small Business Consultants, and I'd like to talk to you today on this video about two Contra accounts. Now, if you're a consultant or hope to be a consultant one day, you want to make sure that you understand how you can read your client's financial statements. And sometimes there are two accounts that will show up, or most of the time there are two accounts that will show up on the financial statements, and I want to make sure that you understand what those are. Let's discuss the first one. The first one we want to talk about is what is called the allowance for doubtful accounts. Sometimes you'll see the name that'll say allowance for uncollectible accounts or allowance for bad debts. This just simply means the amount of the total receivables that your client does not think that they are going to collect. As we know, not everybody pays their bills when they're supposed to, or even pay their bills, period. This is called a Contra account because it is being subtracted from another account on the balance sheet. Obviously, this is being subtracted from the total accounts receivable on the balance sheet. Now let's look and see how that appears on the balance sheet and how we come up with that number. Let's take for an example the accounts receivable total of $32,500, and let's say that the allowance for the doubtful accounts or allowance for bad debt is $7,200. This is a net account receivable figure of $25,300. That means that this is the net realizable value of the account receivable. That means this is what your client actually thinks that he or she is going to collect after all of the invoices are mailed out periodically, after all of those customers pay either currently, 30 days, 60 days, 90 days past due. This is telling us that out of the $32,500, we really think that only $25,300 is going to be collectible, a net realizable value. Now, what's the purpose of really putting something like this on the balance sheet? Well, it's so any reader of the financial statements, which would be the owner, your client, it could be a vendor, it could be a banker, some other type of lender. Individuals reading the financial statements want to know what is the true financial picture of this particular company. Well, if we only had $32,500 on there for account receivables and we did not have any allowance account, that's really actually misleading, because if I'm the owner of a business and I think that we're only going to receive $25,300, it's misleading then to put $32,500 on the balance sheet. Now, how do we come up with this $7,200? Well, if the allowance account, first of all, is not estimated fairly accurately, then our expected future cash flow is not going to be accurate either. So it's very important that this allowance for doubtful accounts is figured accurately. How is that done? Well, there are several different ways. We can take the bad debt expense in prior years. That's a great starting point. But then we also have to make an adjustment for the economy. If the economy is faltering, we're probably going to have a higher bad debt than we've had in previous years. If the economy, however, is getting better, then we're going to probably have a little bit better experience collecting on the bad debts. Also, the age of the receivables makes a difference. In other words, are most of the receivables fairly current or within 30 days, or do we have a large portion of the receivables that might be 60, 90, or 90 days past due? If that's the case, then we know that probably that figure is going to go higher, and we would need to adjust the bad debt experience in prior years, because it could be that in the last 3 years, most of the receivables on the books were fairly current, of 0 to 60 days. But now it could be that the receivables on the books, that a large majority of those are 60 or 90 or 90 day plus past due. Then we would have to make an adjustment. And there could be any other type of important factors. There might be one large account that for some reason is not paying. So this is the what is called a Contra account, allowance for bad debts, that is being subtracted from the receivables. Now, can you think of any other Contra account that might appear on a balance sheet? Let's take a look at one more. This is the accumulated depreciation account. It is another contra account because it is being subtracted from the total amount of furniture, fixtures, equipment, or what is called long-lived assets. Now, what accumulated depreciation is, as you probably well know, depreciation expense is the expense of a purchased asset that is written off over a period of time. In other words, rather than writing off the entire cost of a long-term asset in the year that it's acquired, we take a proportionate amount of that cost over a period of time, less normally a salvage value. And there are several different ways to depreciate an asset. Well, the accumulated depreciation is the amount of depreciation that has been accumulated over the years from the start of depreciating that particular asset. So in this example, let's say we have $64,000 of long-lived assets or long-term assets minus $6,000 of accumulated depreciation. This gives us a net figure of $58,000. Now, what is important, this $58,000 is referred to as book value. The most important thing to remember here, this is not fair market value. This is simply the cost of the assets. In using generally accepted accounting principles, what is called the historical cost principle, we always record an asset at what it cost. We never revalue that asset for the fair market value unless we were doing some type of special purpose fair market value financial statements. But normally we will always keep it at the cost, which is $6,000, or excuse me, $64,000 in this case, less the accumulated depreciation, so this is the book value. The reason it is not fair market value, and that's because these items are never adjusted on the balance sheet. They always stay at cost. They are not adjusted to fair market value. Now, could the book value ever be the same as the fair market value? Just by coincidence, it might be the same. In other words, if we went out and said, well, how much would this used equipment be on the market? There's a slight chance, very slight chance probably, that the fair market value could equate to the book value, but that would be very, very unusual. So the book value is simply the historical cost less the accumulated depreciation. Well, I hope that this discussion has helped you a little bit understand more about contra accounts and how they would appear on the balance sheet. Thanks for watching this video.